In early 2025, the European Central Bank issued a routine clarification regarding payment system choices for European financial institutions. The statement emphasized that banks operating under European regulatory frameworks may select payment infrastructure based on commercial factors, including efficiency, cost, and client requirements. While the announcement attracted limited attention outside banking circles, it reflected a significant shift in the international payments landscape that has been developing over the past decade. The context for this evolution is rooted in technological advancement, commercial pragmatism, and the changing geography of global trade. European financial institutions are increasingly evaluating alternative payment infrastructure not as a political statement, but as a response to client demand and competitive pressure. Understanding why requires examining both the limitations of existing payment systems and the capabilities of emerging alternatives. International payments have long relied on the SWIFT network, established in the 1970s to provide secure messaging between financial institutions. SWIFT itself does not move money, but rather transmits instructions about intended payments. The actual transfer of funds occurs through correspondent banking relationships where banks maintain accounts with each other to facilitate cross-border transactions. This system has served global commerce effectively for decades and remains the backbone of international finance. However, it reflects the technological capabilities of its era. A typical cross-border payment involves multiple steps and intermediaries. When a European company purchases goods from China using dollar settlement, the payment typically converts from euros to dollars, travels through the SWIFT messaging network, passes through correspondent banks in multiple jurisdictions, then converts from dollars to yuan before reaching the recipient. Each stage involves fees. Each currency conversion incurs spreads, and the complete process typically requires 2 to 3 business days. The costs vary considerably depending on the banks involved, transaction sizes, and existing relationships. Industry research indicates that cross-border payment costs can range from under 1% to over 5% of transaction value. Small and medium enterprises generally face higher costs than large corporations with established banking arrangements. Beyond direct fees, settlement delays create indirect costs by requiring companies to maintain larger working capital reserves to bridge the gap between shipment and payment. For businesses conducting occasional international transactions, these costs and delays are manageable. For companies with substantial ongoing trade relationships, particularly with major trading partners like China, the cumulative impact becomes significant. This is where alternative payment infrastructure enters the consideration. China launched CIPS in 2015 as infrastructure to facilitate yuan-denominated cross-border transactions. Initial international reaction was muted, with many analysts viewing it as a supplementary system that would serve niche purposes rather than compete with established dollar-based settlement. The dollar's dominance in international trade appeared unassailable, and SWIFT's network effects seemed insurmountable. However, CIPS represented more than simply replicating existing infrastructure with Chinese characteristics. It incorporated modern technology, including real-time processing capabilities and direct settlement features. Rather than functioning solely as a messaging layer requiring separate correspondent banking arrangements, CIPS enables participating institutions to settle WAN transactions more directly, reducing intermediary steps. For transactions between CIPS participants, settlement can occur on the same day rather than requiring multiple days. The system has grown steadily since its launch. As of 2024, over 1,300 financial institutions across more than 100 countries and regions had connected to CIPS, with daily transaction volumes reaching several hundred thousand operations. This represents genuine infrastructure that European companies increasingly rely upon for China-related business. The system's architecture allows for integration with digital currency initiatives and smart contract functionality for trade finance. A European supplier selling components to China can potentially structure payment through smart contracts that release funds automatically upon confirmed delivery, reducing the need for extended trust between parties and eliminating manual payment authorization delays. This is not merely incremental improvement, but represents a qualitatively different approach to settlement. CIPS processes yuan transactions, but its significance for European institutions extends beyond simply handling Chinese currency. The system connects with bilateral currency swap arrangements between central banks, creating pathways for currency conversion that bypass dollar intermediation. The European Central Bank and People's Bank of China established a bilateral currency swap line in 2013, subsequently renewed and expanded. These arrangements allow central banks to exchange currencies directly, providing liquidity to commercial banks in their respective jurisdictions. European banks can access yuan liquidity from the ECB rather than needing to purchase yuan with dollars first. This creates an ecosystem where European companies can conduct China trade entirely in euros and yuan without involving the dollar. Euro to yuan conversion occurs through official central bank channels rather than through commercial currency markets with wider spreads. Payment flows through CIPS rather than dollar correspondent banking chains. Settlement completes the same day rather than requiring multiple days. The dollar is not prohibited or explicitly rejected in such transactions, but simply becomes unnecessary. This distinction matters enormously. When the dollar is optional rather than required, basic economic incentives take over. Companies compare the cost of dollar settlement against direct euro-yuan settlement and choose whichever proves more efficient. Multiple major European banks, including institutions in Germany, France, and the United Kingdom, have established yuan clearing capabilities, often working with the ECB swap line facility. This development reflects client demand rather than political positioning. Banks serve corporate clients conducting business in China who want efficient, cost-effective payment solutions. Consider a realistic example of how these economics work for European businesses. A German automotive parts manufacturer with 3 billion euros in annual revenue derives 40% of its business from China, approximately 1.2 billion euros yearly. Until recently, virtually all transactions used dollar settlement. Under the traditional process, when a Chinese customer orders components, the manufacturer ships them and the customer's bank converts yuan to dollars, sends those dollars through SWIFT and correspondent banking channels, and the manufacturer's bank receives the dollars several days later, converts them to euros, and credits the account. This involves two currency conversions, each with associated spreads typically ranging from 1 to 2%. Correspondent banking fees add additional costs. The total transaction cost might reach 3 to 4% of transaction value. Beyond direct fees, settlement delays create significant indirect costs. The multi-day gap between shipment and payment receipt forces companies to maintain substantial working capital reserves. A company might need to borrow tens of millions of euros as working capital to bridge payment delays, incurring interest costs. Currency fluctuations during the settlement period create risk requiring hedging expenses. When Chinese clients began offering yuan settlement through CIPS, European companies conducted cost-benefit analyses. With direct settlement, there is one currency conversion instead of two, same-day settlement instead of multi-day delays, no correspondent banking fees, and reduced need for currency hedging since conversion happens immediately. The transaction cost might fall to under 1% of transaction value. Working capital needs decline substantially with same-day settlement, reducing borrowing and associated interest expenses. For a company operating on margins of 5 to 6%, this difference is profound. It represents millions in annual savings and a decisive competitive advantage. One by one, European companies with substantial China business have adopted yuan settlement arrangements. The business case is simply too compelling to ignore. This pattern has repeated across sectors. French aerospace companies, Italian machinery manufacturers, German chemical firms, and Spanish agricultural exporters with significant China trade have reached similar conclusions. Yuan settlement reduces costs, therefore shareholders expect management to utilize it. European banks, facing competitive pressure, must provide these capabilities or risk losing clients to institutions that do. This is how payment infrastructure evolves. Not through grand political declarations, but through thousands of corporate procurement officers analyzing transaction costs and recognizing that alternative arrangements save money. Each individual decision is rational and commercially justified. Collectively, these decisions shift the underlying architecture of international commerce. The proportion of Euro-China trade settled in yuan has grown substantially over the past several years. While precise figures vary by source and measurement methodology, Yuan settlement has moved from negligible levels a decade ago to representing a significant minority of bilateral trade. Major European corporations, including well-known automotive, industrial, and technology companies, now routinely use yuan settlement for China transactions. This shift does not mean the dollar system is collapsing or that American financial influence is ending. The dollar remains the dominant global reserve currency and the primary medium for international trade. Most commodities are still priced in dollars. The vast majority of foreign exchange reserves are held in dollars. SWIFT continues to process the overwhelming majority of international payment messages. What is occurring is diversification rather than replacement. The international monetary system is becoming modestly more multipolar, with the yuan playing an expanded but still secondary role. European adoption of Chinese payment infrastructure reflects commercial logic rather than geopolitical realignment. Companies use payment systems that efficiently serve their business needs. When those needs involve substantial trade with China, direct yuan settlement increasingly makes sense. The European Central Bank's statement regarding payment system choice reflected this commercial reality. European regulators recognize that their jurisdiction's financial institutions serve clients conducting legitimate business globally. Restricting access to efficient payment infrastructure would disadvantage European companies in international competition. This creates a subtle but significant shift in the transatlantic relationship regarding financial infrastructure. For decades, American control over dollar clearing provided Washington with substantial leverage for foreign policy objectives. Sanctions could be enforced by blocking access to dollar payment systems. Countries and companies dependent on dollar settlement had to accommodate American policy preferences. As European companies develop alternatives for significant portions of their international business, this leverage diminishes marginally. Europe is not abandoning the transatlantic alliance or rejecting the dollar system entirely. Rather, European institutions are asserting that commercial infrastructure should primarily serve commercial needs. Payment system choice becomes a business decision rather than a geopolitical statement. American policymakers have expressed concerns about this development, viewing expanded use of alternative payment systems as potentially complicating sanctions enforcement and reducing financial leverage. European officials respond that their companies must remain competitive in global markets and that restricting access to efficient infrastructure would harm European economic interests. This tension reflects a genuine dilemma. Financial infrastructure serves both commercial and policy functions. When these functions conflict, difficult trade-offs emerge. European leaders have generally prioritized commercial considerations while maintaining that they will comply with European sanctions policies and international legal obligations. The expansion of alternative payment infrastructure has implications that extend beyond Europe and China. Other regions observe European adoption of CIPS and UN settlement as validating these approaches. If America's closest allies actively use Chinese payment systems without facing prohibitive costs, other countries perceive these options as legitimate business tools rather than provocative political statements. Brazil and Argentina have expanded UN settlement for bilateral trade. Southeast Asian nations have developed UN settlement frameworks. African countries have explored UN-based regional payment systems. Each instance references European precedent as demonstrating that multiple payment systems can coexist and that choosing efficient infrastructure is commercially rational. This does not mean the yuan is replacing the dollar as the global reserve currency. China's capital controls, less developed financial markets, and concerns about rule of law limit yuan adoption for reserve holdings and many financial transactions. The dollar retains overwhelming advantages, including deep, liquid markets, strong property rights, and decades of established trust. What is changing is the degree of dollar dominance at the margins. If yuan settlement handles 20 to 30% of certain trade corridors rather than 5%, the dollar's position remains strong but slightly diminished. This marginal shift has real consequences for American economic policy. Sustained foreign demand for dollars has historically supported the currency's value, making imports inexpensive for American consumers. A strong dollar has allowed the United States to run persistent trade deficits while maintaining price stability. This arrangement has facilitated American consumption patterns and supported government borrowing at relatively low interest rates despite substantial debt levels. If foreign demand for dollars moderates due to expanded use of alternative currencies in international trade, the dollar might weaken somewhat, making imports more expensive and potentially requiring higher interest rates to attract foreign capital for government debt financing. These effects would be gradual rather than catastrophic, but they could necessitate adjustments in American fiscal and monetary policy over time. Beyond immediate cost considerations, technological advancement in payment infrastructure influences adoption decisions. CIPS incorporates more modern architecture than systems designed in the 1970s. The ability to integrate with smart contracts, digital currencies, and real time settlement reflects current technological capabilities rather than legacy constraints. SWIFT has announced significant modernization initiatives, including instant payment capabilities, reduced costs, and improved transparency. The competitive pressure from alternative systems has spurred innovation across the industry. International payments are becoming faster, cheaper, and more efficient, regardless of which specific infrastructure handles individual transactions. This technological evolution benefits global commerce broadly. Companies gain access to better tools for managing international transactions. Consumers benefit from lower costs that can translate to lower prices. The diversification of payment infrastructure creates redundancy that enhances resilience. From a systemic perspective, having multiple viable payment networks reduces single points of failure. If disruption affects one system, alternatives exist. This redundancy has value for global economic stability, even as it creates challenges for policy coordination. European adoption of alternative payment infrastructure reflects broader strategic thinking about economic autonomy and competitiveness. European leaders recognize that their industrial base faces intense competition from China in sectors including electric vehicles, battery technology, renewable energy, and advanced manufacturing. Chinese companies often benefit from integrated domestic supply chains, government support, and efficient infrastructure. European companies competing against Chinese firms need access to similarly efficient tools. If transaction costs for China trade are substantially higher for European companies than for their Chinese competitors, this creates a structural disadvantage. European policymakers face pressure from industry to provide infrastructure that allows European companies to compete effectively. This includes payment systems that facilitate efficient trade with major partners. Restricting access to such infrastructure for political reasons would disadvantage European industry while providing no compensating benefit. Europe's relationship with the United States remains fundamentally strong, rooted in shared values, security cooperation, and deep economic ties. However, that relationship coexists with European interest in maintaining strategic autonomy in areas including economic policy and infrastructure. The decision to support European financial institutions' use of efficient payment systems for legitimate commercial purposes reflects this balance. Looking forward, the international payment landscape will likely continue evolving toward greater diversity. The dollar will remain central to global finance for the foreseeable future, but its degree of dominance may moderate as alternative systems mature and prove reliable. This represents evolution rather than revolution in the international monetary order. For European financial institutions, the path forward involves managing multiple payment systems simultaneously, maintaining dollar clearing capabilities, while also offering efficient UN settlement for appropriate transactions. Banks that successfully navigate this complexity will serve clients effectively and remain competitive. Regulatory frameworks will need to adapt to this multipolar reality, ensuring that payment diversity serves legitimate commercial needs while maintaining appropriate oversight for compliance, security, and stability. This requires international cooperation and continued dialogue among regulators across jurisdictions. The technological dimension will remain crucial. Continued innovation in payment infrastructure will drive further efficiency gains regardless of which currencies or systems handle specific transactions. Competition between systems creates incentives for improvement that benefit end users. Ultimately, the question of why European financial institutions are looking at China's payment networks has a straightforward answer rooted in commercial logic rather than ideology. These institutions serve clients conducting substantial legitimate business with China. Alternative payment infrastructure offers cost savings, efficiency gains, and technological advantages for that specific use case. In a competitive environment, financial institutions must provide the tools their clients need to operate successfully. This represents market forces at work in the infrastructure layer of global finance. Individual companies make rational decisions based on their specific circumstances. Financial institutions respond to client demand. Regulators balance commercial needs against policy objectives. Collectively, these decisions gradually reshape the architecture of international payments. The result is not the collapse of existing systems, but the emergence of a more diverse ecosystem where multiple payment infrastructures coexist and serve different needs. This evolution creates both opportunities and challenges, but it fundamentally reflects the ongoing adaptation of global financial architecture to changing patterns of trade, advancing technology, and the legitimate commercial interests of businesses operating in an interconnected world economy.